Today, we're talking about fixed income investments and why now could be a great time to invest in a mortgage REIT. As you know, the Federal Reserve has been quick to increase interest rates. If you are a borrower, you're seeing the cost of borrowing go up substantially. But what you may not know is that this has had a positive impact on the returns of fixed income investments, particularly for a mortgage REIT. So I want all my fixed income investors, even those investors that have traditionally invested in more risky investments, such as the stock market, to listen carefully. As interest rates rise, the yields on fixed income investments, such as bonds and mortgages, also increase. This means that individuals who invest in these types of investments can earn a higher return. And every time the Fed raises interest rates, so does the return for the investor. And that is why high net worth investors, family offices, and private equity funds have been shifting into the private real estate debt market. They're chasing returns that they haven't seen since the Great Recession. Now, if you're a borrower of money, such as a real estate investor, this isn't a good thing. You are now paying a lot more to borrow money. But I'll tell you what, I do not feel bad for you, as you've been borrowing funds at near 0% interest rates since 2010. Now it's time for the lenders to make some money here, and this includes investors that rely on fixed income investments. So what is a mortgage REIT? Mortgage REITs are simply an investment that is comprised of a basket of residential or commercial mortgages. You, the investor, become a shareholder of the mortgage REIT and a part owner of the mortgages it owns. You, the shareholder, then earn income from the interest paid on those loans. That income is distributed to you in the form of a dividend. So let's talk about why you might want to consider an investment in a mortgage REIT. So as the Fed raises interest rates, mortgage REITs can charge a higher rate for their capital and thus return a higher yield to their shareholders. In addition to the higher returns, mortgage REITs are often structured to pay monthly or quarterly distributions to their investors. And they're eligible for a 20% tax deduction on the monthly gains. Yes, I'll say that again. The distributions, the monthly or quarterly distributions, are eligible to earn a 20% tax deduction. That means as an investor, you're only paying income tax on 80% of that income. This is why they're such a great investment for fixed income investors. Mortgage REITs are also a great way to diversify your portfolio, as real estate has traditionally been a less volatile investment than the stock market. And if you want exposure to real estate without actually owning and managing real estate, mortgage REITs offer you the exposure without having to own and manage it. And lastly, mortgage REITs are much more liquid than owning physical real estate. Of course, like any investment, there are risks associated with investing in a mortgage REIT. Not all mortgage REITs are the same. Some mortgage REITs invest in residential mortgages, others commercial, and some a blend of the two. Others may focus on specific parts of the country, others may lend nationally. That is why I always suggest that you do your due diligence on investing in a mortgage REIT. And if you do decide to invest, do your homework and check out the various options that you have to invest in. If you're interested to learn more about investing in a mortgage REIT, trust deeds, and other fixed income investments associated with real estate, be sure to subscribe to this channel. And if you like this video, consider giving it a like. Thanks for listening.